Have you ever wondered where prices for insurance come from? How much are they charging you? Why are they charging that much? And do you ever feel like it's unfair? I'm here to explain the difference of how insurance companies make their money and how much of it you're paying for. So real fun fact, I actually learned a few things. I've been doing this for about 6-7 years now. I'm licensed in 38 plus states. I sell insurance in just about all of them. It's pretty basic when it comes to insurance. There's a lot of set guidelines, and then each state has their little specifics with things. But the profit of an insurance company looks huge if you really look at them, and it really is. They make a lot of money, but how much are they actually taking out of your pocket? One of the biggest things that people think is insurance companies are out to get you. They're not. They're just like any other company. They're trying to make as much money as they can. So what they're doing is they're trying to make as little claims as possible, insure at the highest possible value that you're willing to pay for in competition with all these other companies. Each department has a different section. So what an insurance company does is they take their product line and they have actual people that check the prices. They say, okay, what are our competitors doing? How much can we do? And how much can we earn? What type of business are we going after? Are we going after the high risk people that only do, that have a higher chance of getting an accident? They're in a probably a little worser area as far as claims go. More natural disasters could happen there. Or do we want to go more of a confident planner? Do we want to stick with just the people that we know want insurance? They see the value. They want to talk to the company that's going to take care of them for life. They don't want to have to worry about it. So there is different types of insurance. However, most companies have different companies that do both. So like you have Farmers Insurance, they have Bristol West, that's their higher risk company. You have Geico, who naturally is a higher risk company, although they've got pretty good margins. But you also have Allstate, who have Esurance. So that's more of, they call it a direct model. It's a little different, but it's more of a higher risk. That's the type of person that you're pulling in. Your confident planner typically wants to talk to a specific agent. The way an insurance company makes their money is they invest the money that you've paid into the stocks. They put stocks and bonds and anything that's more liquidatable. So if there is a major claim, they can pull that money out and pay those claims. They take the amount you're paying for the premium, subtract the amount that they estimate could possibly happen, so the odds of you causing a claim or filing a claim, and then that's your combined loss ratio. They want to be 0.97 cents, so 97 cents per dollar is what their average is. That is tiny. You have a $1,000 policy. They're making $30 on that $1,000. That risk for them taking you on is so much greater than that profit that they're making. But here's the trick. See, they're going to take that money that you're giving them for the service and they're going to invest it into bonds, stocks, the market, anything that's growing, something that will earn them interest. So if they can make 6%, 8% on that $1,000, that's where their money comes from. Just to give you an example, I'm going to read this right from my cell phone here. I had to look this up myself just to make sure I was right. So this is from 2011. It doesn't matter because it hasn't changed. There's not a different way that they invest. They invest how much they invest, and that's the thing. However much premium they take in, they put as much of it in the investment, and they take out to pay any shareholders if they have a shareholdership. This is an example from 2011. In 2011, State Farm collected $32.640 billion in premiums. They paid $22.794 billion in claims. They lost $1.993 billion. That's crazy. They lost almost $2 billion. But here's the kicker. They actually earned or made $2.9 billion in revenue. So even though they paid out almost $2 billion in claims, they actually made almost $3 billion for that year. See, when you take that money and invest it over time and it grows, it's like that snowball you see whenever you're watching those investment channels. It grows and it grows, and now they've got billions of dollars growing, and it's just massive. And so they just keep investing it, taking little pieces out for their investors or for the, for the different things. When there's a major claim or major loss, that's where it hurts. That's also why you see the insurance prices go up. Because if the stock market goes down, the money starts disappearing, and then the claims go up. Boom. you could be completely out of business. So in reality, when somebody says, hey, we're only making 5 cents on this policy, that's not where they're making their money. So the insurance companies aren't necessarily trying to take advantage of you. They're going to earn the money with or without you. They're just praying that you guys don't file a claim, because the more claims that go in there, the lower their profit margin. The lower the stock market goes, the lower their profit margin. If both of them go bad opposite, then they're done. They're going to close the doors, because you can't make money when the stock market's dead and you're paying out all these claims and you took in the low money, paid out a lot, and it's done. As long as the stock market's good, which it's pretty much always been, if it fluctuates, so that's why insurance companies go crazy. In 2016 and early 2017, there was a little bit of shift. Now, because the economy has kind of flipped around a little bit, a lot of companies are getting more claims, not because there's more accidents, but but what's happening is a lot more people can afford newer cars, nicer cars. So there's a lot more people driving, a lot more people purchasing cars. The gas prices have been down lately. There's a lot more activity. In the insurance companies, there's not really a way to track that. They're trying to put it in their bubble so they can, figure out how much to pay you. The government regulates what the insurance company can do. So they can't come out and take advantage of you. Whenever you take a policy, you purchase that premium, what's happened is the agent or the person that quoted you, it might be a direct salesperson. So what they did is they typed in all your information in the computer, and they had created an algorithm or a worst case scenario with all of your discounts. If you're a not smoker, if you're married, if you own a house, go look at my other video for discounts. If you match all those criteria, you're a lower risk. That means the premium is going to be lower for you. There's something called underwriters, and what their job is to do is to underwrite the business. So if you have your estimated claims, so we expect that you're going to file a claim for $600 in the next 5 years. We want to underwrite that business just a little bit below, just so you're not, it fits the premium that you can pay for the risk. They're not going to lose their shirts, and they're going to be within usually a 3% difference. That's why they say every 90 cents, every dollar that they take in, 97, 98% goes out. Some companies go really aggressive and they just need new customers. So some of them plan on being overpaid out. So they expect to take in $1, pay out $1.10. They're trying to pull in customers and then hope that the risk isn't that high. That way they don't lose out. It's a risky way to do that. So if you ever see a company having a higher loss ratio than they're taking in, that's a good indication that things are going to change pretty quickly. The best way to check this, if you guys want to find out where the stability of a company is, there is a website. It's called AM Best. You just type in Google AM Best, and they're a company that rates other companies. So if you want to see what insurance company is doing well, which one has the best loss ratio, then go check that out. It's really simple. They're rated in A to B form, so an A plus or an A plus plus, I believe, is the max. If a company is an A plus or higher, that means they're stable. They're not likely to fluctuate as much as prices. If you guys want more advice or more tips or just have general questions, leave them in the comments below. I'd love to answer them, love to help you out. Hope this helps. If you guys would love to help me out, share the video with anyone you want. Don't forget to like and subscribe at the bottom. And welcome to my channel. I don't have an intro or an outro, so whatever. For now, this is Mark signing off.